Welcome to today's Explainer. We're diving headfirst into a massive, deeply misunderstood legal labyrinth that's currently affecting millions of Americans, the student debt crisis. We're going to look at how both federal and private student loans were designed with an incredibly easy point of entry, but an almost impossible exit. We'll unpack the legal history, bust some pretty wild myths, and then explore a fascinating, science-backed proposal to help people actually escape. To start things off, we really have to ask a fundamental question. Why are student loans treated like absolutely no other consumer debt in America? Think about it. If you rack up credit card debt, personal loans, or even medical bills, the bankruptcy courts offer a structured, albeit painful, way out. But student loans? The doors are practically welded shut. This forces countless borrowers into a lifetime of financial strain. Today, we're going to look at the exact legal mechanisms that created this reality. As a recent law review article perfectly put it, a student loan resembles a labyrinth. You see, the system's central goal was always to provide access to higher education funding to as many people as possible. But the actual repayment mechanism, that was kind of treated as an afterthought. It's incredibly easy to walk in, but trying to navigate your way out in the dark is a completely different story. Section 1. The Student Debt Labyrinth. Right now, we're looking at 43.5 million borrowers sharing over $1.75 trillion in total student debt. It's a staggering number. But who's actually defaulting? You'd probably assume it's the folks with those massive six-figure debts, right? Well, actually, the data shows a highly counterintuitive reality. The absolute highest default rates actually occur among the third of borrowers with the lowest balances. These are often people who took out a modest amount of debt but had to drop out before finishing their degree, so they're left with a financial burden but without the increased earning power that a degree provides. And the danger of this labyrinth is immediate. Almost 41% of borrowers will have at least one delinquent payment, and nearly 11% of all borrowers enter default within their very first year of repayment. The system doesn't slowly overwhelm people. For many, it trips them up the second they cross the starting line. This leads to costly forbearances that honestly just dig the hole deeper. So how did we get here? How did this specific debt become so remarkably sticky in the eyes of the law? Section 2, the deadbeat borrower myth. To understand our current crisis, we have to look back at a really powerful narrative that took hold in the 1970s. Initially, from the 1944 GI Bill all the way to the 1965 Higher Education Act, federal loans were seen as an anti-poverty and national defense tool. They were a good thing. But by the mid-1970s, a sudden legislative panic set in. Congress became completely obsessed with the idea that students were abusing the system, which led directly to the 1976 restrictions on bankruptcy discharge. And here's where the actual data tells a completely different story from the panicked headlines. The big myth was that 1 in 6 recipients were casually filing for bankruptcy right after graduation just to dodge the responsibilities. Members of Congress were citing statistics to stoke these fears, like a supposed 225% increase in student bankruptcies in Pennsylvania. But the reality? That 225% jump was literally an increase from just 4 bankruptcies up to 13. Seriously, 4 to 13. Overall, only 0.2% of all student loans were actually being discharged in bankruptcy. So a moral panic, driven by totally statistically insignificant data, created these draconian laws, laying the groundwork for a permanent trap. Section 3. The Bankruptcy Trap. Thanks to some incredibly confusing legislation, getting out of a student loan through bankruptcy today requires proving what's called undue hardship. And in a courtroom, this is an impossibly high hurdle. Courts regularly interpret this provision as demanding a certainty of hopelessness. You essentially have to prove to a judge that your financial life is irreparably ruined forever before they'll even consider granting relief. It completely removes the standard consumer protections that we usually rely on for a healthy economy. Now, the plot really thickens when we look at private loans. Federal loans are guaranteed by the government and have no credit check, right? They were restricted in bankruptcy to supposedly protect taxpayer money. But private loans are totally different. They actually screen for creditworthiness and market directly to consumers. Yet, the 2005 Bankruptcy Abuse Prevention and Consumer Protection Act inexplicably extended these super strict federal bankruptcy protections to private lenders too. It removed the risk for private lenders, ultimately saddling a huge swath of the workforce with inescapable debt and dragging down broader economic mobility. In fact, within just 6 years of this change, the outstanding balance of private student loan debt almost tripled. Yet there's actually a legal loophole here that most borrowers don't even know exists. Not every single debt incurred by a student is automatically non-dischargeable under the bankruptcy code. The law specifically protects qualified education loans, meaning funds used solely for the certified cost of attendance at an eligible institution. So if a private lender gave a student a direct-to-consumer loan that exceeded that actual cost of attendance, the excess amount might actually be dischargeable. But of course, the lenders aren't exactly rushing to tell you that. Section 4. Private Lender Exploitation. Private lenders aggressively weaponize these legal changes for their own profit. They've routinely misrepresented the law, basically telling struggling borrowers that absolutely no education-related loans can ever be discharged. But here's the kicker. In their prospectuses to Wall Street investors, they openly warned that certain private loans might actually be discharged in bankruptcy. So they knew the truth, but they weaponized the confusion anyway, sometimes even continuing collection efforts on loans that had legally been wiped out by a bankruptcy court. As you can imagine, this creates a massive chilling effect. Between 2015 and 2020, about 250,000 people with student loan debt filed for bankruptcy. But less than 1% of them actually filed an adversary proceeding to try and get their student loans discharged. The incredibly selective, well-funded litigation strategies of these private lenders have totally distorted legal precedents and built a massive wall of deterrence. The vast majority of borrowers don't even try to escape because they've been convinced it's flat-out impossible. So if the legal system is just this reactive, expensive trap, how do we actually fix this? Section 5. Gamifying debt repayments. Well, we need to pivot from a broken judicial system to a proactive, behavioral science-backed solution. Source research from the University of Arkansas at Little Rock Law Review argues that the most effective way to solve this crisis isn't through reactive courtroom litigation, but by building engaging, servicer-agnostic debt management platforms. We need to help borrowers navigate the dark labyrinth before they ever hit the wall of default. Gamifying repayment directly combats major psychological barriers like math anxiety and cognitive overload, and it does it in 3 steps. Step 1 is just-in-time education. This means delivering tailored financial advice exactly when the borrower is making a decision, rather than just overwhelming them with paperwork at graduation. Step 2 uses algorithmic nudging to make the absolute best financial choice the path of least resistance. And Step 3 provides incremental rewards to keep borrowers engaged and motivated over the long haul. The cool thing is, we're already seeing fintech innovations step up in this space. Apps like Chipper utilize automated choice architecture to help borrowers incrementally chip away at their debt. They connect to your bank account, round up everyday purchases to the nearest dollar, and then apply that spare change directly to the loan principal. Or they offer cashback rewards on purchases that go straight toward paying down the debt. It's brilliant because it allows borrowers to incrementally fight back without having to make massive, painful opt-in decisions every single month. The contrast here is just night and day. The current Labyrinth relies on third-party servicers who have very little accountability, which leads borrowers into costly forbearances and capitalized interest traps, and it usually ends in complex court battles. But a gamified solution that offers a centralized, dynamic platform that bypasses the trial and error suffering of millions. It acts as a single, intuitive hub for borrowers to understand both their federal and private loans, make optimized biweekly payments, and escape the debt so much faster. Which leaves us with one final, pretty provocative thought. If we actually build these platforms, who pays for them? It shouldn't be the taxpayer, and it definitely shouldn't be the already overwhelmed borrower. So what if educational institutions themselves were required to fund these gamified tools, scale directly to the default rates of their own alumni? Shifting that accountability back to the institutions that generate the debt in the first place? Well, that might just be the key to fundamentally reshaping the entire future of education funding.